Guys, welcome to part 2 of the chapter 1 of audit. Yesterday I had completed a few topics from the first chapter in this revision. I've made a list of all the topics that are there in the chapter. We had already discussed what an audit is, what an assurance engagement and its elements are, say 200 opinion, what does pervasive mean, what are the who are those charged with governance, preconditions or preliminary conditions, and then the internal control, test checking, professional judgment framework for an audit, risk assessment procedures, further audit procedures, and the assertions. So we had completed till there. I'll just give a quick summary of things that covered already. Okay, so first starting with the audit. Audit is an independent examination of the financial information of any entity, basically of any entity, whether profit oriented or not, irrespective of size or legal nature or legal form, right? So here this examination is conducted with a view to express an opinion on that. Okay, so that was what we had discussed about audit, and we had seen what does financial statement mean also. This financial information is the historical financial information, right? Historical financial information, and this is the information that is expressed in financial terms relating to a particular entity from its accounting system, right, about the economic events and conditions of that particular entity. Right now, what is financial statements? Financial statements are structured representation of financial information. It includes the related notes, communicates the entity's resources and obligations, and it is prepared as per a financial reporting framework. Now, what is a financial reporting framework? A financial reporting framework is something that gives guidelines on how to prepare your financial statements with regard to the amount, the classification, presentation, and disclosure. Okay. Next, AFRF or the applicable financial reporting framework is the FRF that is adopted by the entity for preparation and presentation of financial statements. Okay, so it must be, FRF must be accepted as per the nature of the entity, as per the requirement of laws and regulation, right? Moving on. Next, we came to assurance engagement. I've already repeated this maybe 5, 6, 7 times in the previous video. So if you're watching this video, I would recommend you to watch the previous video first and then come to this video. Okay, anyway, let's move on. Okay, so what is an assurance engagement? An assurance engagement is when a practitioner obtains sufficient appropriate evidence in order to express a conclusion designed to enhance the degree of confidence of the intended user other than the responsible party about the outcome of the evaluation or measurement of a subject matter against a criteria. Okay, so here we have discussed the 5 elements. What are the 5 elements? There are the parties that are involved, and then the subject matter itself, and then the criteria against which it is checked, and then the sufficient and appropriate evidence, and lastly the conclusion. So these are the 5 elements of an assurance engagement. Okay, so here the parties are the practitioner, the person who does the checking, the person who checks the subject matter against a criteria is the practitioner. Responsible party is the person is the party that is responsible for the preparation of the subject matter. Okay, so responsible party gives the subject matter. Intended user is the person who uses that subject matter to make any informed economic decision. Okay, right? So here subject matter can be anything. It can be the financial statements, or it can be right, it can be the financial statement, or it can be any other information, financial information relating to a particular entity, right? Next, the criteria is whatever guidelines or rules or regulation that is applicable for the preparation of that subject matter and lastly, last but one is the sufficient and appropriate evidence. What does sufficient mean? Sufficient means whether there's enough quantity based. Appropriate means whether there's enough quality, right? So that is all that we have to remember and write in our answers. And then a written conclusion is given by the practitioner to the intended user. Okay, moving on. What is the objective of the independent what is the overall objectives of the independent auditor? That is given in the SA 200 or the Standards of Auditing 200. It is given there. What is SA 200? It is also called UYA-CASA, right? Overall objectives of an independent auditor and conduct of audit as per Standards of Auditing. Okay, so this is the SA 200. What did it ask you to do? It asked you to RA-ORC. RA is obtain reasonable assurance that the financial statements are free from material misstatement, whether due to fraud or error, right? And then to express an opinion whether financial statements are prepared as per AFRF, right? So it is prepared as per AFRF. And then it also asked you to report on the financial statement. So it also asked you to report on the financial statement and comment or communicate as required by the essays. Communicate as required by essays, right? We'll just see this one. Okay, or here SA 200. Overall objectives of an independent auditor and conduct of an audit as per Standards of Auditing. Obtain a reasonable assurance that the financial statements are free from material misstatement, whether due to fraud or error. Okay, so now what does material mean? What does material mean? Material means any amount or any item that can influence the economic decision or judgment of its users. Okay, so it can be either individual or as a whole, okay, like multiple items together, or it can be an individual particular item. Okay, so if it can influence the economic decision of the or judgment of the users of the information, then it is considered as material. Okay, but what does misstatement mean? So we will learn what material means. Now what does misstatement mean? Misstatement means the difference in the amount, classification, presentation and disclosure as required versus the actual amount, classification, presentation and disclosure. Okay, now here fraud and error are two separate things, right? Fraud is intentional, whereas error is an unintentional. Okay, here detection is hard, here detection is fairly easy, right? And the risk of not detecting is very high because the people who have committed the fraud have taken multiple steps or have taken precautionary measures to hide the fact that they have committed that fraud, right? Here risk of detecting is considerably or reasonably quite low. Okay, so here auditor can use his audit procedures to find out if there is any mistake or if there is any inconsistency, right? Next, he should also express an opinion that the financial statements are prepared as per AFRF. Okay, and he should report on the financial statement and communicate as required by the essays. Okay, next we came to the types of opinion. So there are two types of opinion. Prima facie there are two types, which is unmodified and modified, right? What does unmodified mean? It means that there is no material misstatement, or that the auditor is reasonably sure that there is no material misstatement. Okay, so when will the auditor give an unmodified or rather when will the auditor give a modified opinion? Either when there is a material misstatement, or he is reasonably sure that there is a material misstatement, or that he is not able to find sufficient and appropriate evidence. Okay, we'll just see in detail over here. So if there is material misstatement and it is pervasive, we'll just get to the meaning of pervasive next. Okay, so if there is a material misstatement and it is pervasive, we will give an adverse opinion. Okay, if there is a material misstatement but it is not pervasive, we will give a qualified opinion. Okay, and if the auditor is not able to find sufficient and appropriate evidence and such item is pervasive, we will give a disclaimer opinion. Okay, next is if uh, if if we are not able to find appropriate evidence but that item is not pervasive, we will qualify the opinion. Okay, we will give a qualified opinion basically. Okay, right. Now what is pervasive? It is pervasive means it is used to describe the effect of the misstatement. Okay, so what effect that misstatement has on the financial statement, so pervasive explains that. Okay, so next, a material misstatement can be pervasive based on the auditor's judgment. Okay, so basically the auditor will have to use his professional judgment in this case to find out whether that material misstatement is pervasive or not. Okay, so how will he do that? He will use his training, knowledge and experience. Okay, he will use TKE, training, knowledge and experience, to determine whether that material misstatement is pervasive or not. Okay, now what are the factors that he has to consider? Okay, he can use training, knowledge and judgment, but he has to also consider certain factors. Okay, such factor, okay, it is pervasive if it is pervasive if it is not confined to a specific element, if it is forming part of multiple elements, right? So all of these, it is affecting more than one item, then it is pervasive. Okay, so even if it is one item, even if it is one item and if it forms massive part of the financial statement, it will still be pervasive. Okay, so even if it is confined to a single item, it can be pervasive if it forms substantial part of the financial statements. Okay, now when it comes to disclosures, how do you find out whether a disclosure is pervasive or not? So we will see whether such disclosure is dependent, whether the person who is dependent, uh, it, the fact whether it is pervasive or not is dependent on whether such disclosure is fundamental for the user's understanding of the financial statements, right? So what are this could be very important, okay, because this has come in the exam before. Okay, so it should not confined to a single item, right? Not confined to single item. Okay, next is it could be single item but substantial portion, right? Substantial portion. And lastly, when it comes to disclosure, a disclosure is considered as pervasive if it is fundamental to the understanding of the financial statement, fundamental to understand financial statements. Okay, so it is so these are the cases when it is considered as pervasive. Okay, next, moving on to those charged with governance. Okay, so who are those charged with governance? They have the responsibility of overseeing strategic decision and obligations related to the accountability. Okay, so they have to oversee the strategic direction and they have obligation related to the accountability of the entity. Okay, next, it includes the financial reporting process. TCWG and management are different, however they may be same in certain cases. Okay, next, coming to the preconditions. Preconditions are very important. These preconditions also come in SA 210. SA 210, so it is highly important that we learn it here and then revise it there again. Okay, so here, obviously there are only two preconditions, right? Firstly, we have to determine whether FRF is acceptable. What is FRF? Financial reporting framework. Whether the financial reporting framework that they've used is acceptable or not. Okay. Secondly, we have to obtain agreement that management acknowledges. So they have to acknowledge and understand. Okay. So both these words are necessary. Okay. Obtain an agreement that management acknowledges and understands its responsibilities. What are its responsibilities? It is to PPFS as per AFRF, meaning preparation and presentation of financial statements as per applicable financial reporting framework, and design, implementation, maintenance of internal control to ensure that PPFS is free from error or fraud. Okay, and lastly, allow unrestricted access to those whom the auditor determines necessary for obtaining evidence. Okay, so I think there are two more points are missing over here, which is any information that the auditor may require, or rather all information, and then additional information, and then this will come. Okay, so I think it should be fine. We can just move on, right? Actually, wait, let me just. So here, preconditions are what? Preconditions. Firstly, determine whether FRF is acceptable, right? Nextly, second is what? That we need to obtain an agreement that the management acknowledges and understands its responsibilities, right? Its responsibilities. What are its responsibilities? Firstly, preparation and presentation of financial statements as per applicable financial reporting framework. Second, it is design, implementation and maintenance of internal control, so to ensure that financial statements are free from material misstatement, right? Material misstatement, whether due to fraud or error. Okay, and lastly, provide all information relevant to the audit, or all info related to financial statements, any other information the auditor requires, any additional information, and lastly, unrestricted access to any person that the auditor deems necessary to obtain sufficient and appropriate evidence from. Okay, next, what is internal control? Internal control is a process designed, implemented and maintained by TCWG, or those charged with governance, management and other personnel, who gives reasonable assurance as to the effectiveness and efficiency, the reliability, compliance and the safeguard. Okay, so here, what is internal control? Internal control is the process that is designed, implemented and maintained by those charged with governance, or the management, or any other personnel, right? Or any other personnel. Okay, in order to ensure, or to ensure what? Ensure four things. One is reliability. Next, effectiveness and efficiency. Third, compliance. Pretty sure I'm forgetting something. Compliance and safeguarding, right? So, reliability as to the financial reporting, effectiveness and efficiency of the operations, compliance of the law and regulation, and safeguarding of assets. Okay, simple. Next, so auditor is concerned only with the internal controls related to the financial statements. Generally, auditor is not required to give any opinion on the IC. Remember this. He is not required to give an opinion on the internal controls. However, he may suggest, he can point out any weakness or suggest any improvements. Okay. Next. So now what test checking? What is test checking? Test checking is application of audit procedures to less than 100% of the transactions. Okay, application of audit procedures to less than 100% of the transactions. It is also called as sampling, right? We'll move on to the next part. Next, professional judgment. What is professional judgment? Application of the relevant training, knowledge and experience in making informed decisions about the course of actions that are appropriate in the circumstance. Okay, let's try telling it again. What is a professional judgment? Professional judgment is application of relevant training, knowledge and experience in making informed decisions about the course of actions that are appropriate in the circumstance. Okay, next, what are the framework of audit? Framework of audit includes engagement, planning, materiality, risk assessment, and then response to that risk, and then collection of audit evidence, conclusion, reporting and forming an opinion and reporting, and documentation, right? Okay, so again let's just say that again: engagement, planning, materiality, risk assessment, response to the risk, audit evidence, and then coming to a conclusion, forming an opinion and reporting. Okay, and then lastly documentation. Okay, very simple, right? In that we had discussed in detail about this risk assessment and the response to that risk. Okay, so what did we learn? The risk assessment is the procedure of assessing ROMM, right? Assessing ROMM. What is ROMM again? ROMM is risk of material misstatement. Risk of material misstatement, right? Misstatement, right? Very simple. Okay, so what is risk of material misstatement? Risk of material misstatement means the risk that financial statements are materially misstated prior to the audit. Okay, so prior to the audit. Okay, so there is a risk of material misstatement. And how do we do this risk assessment? We use risk assessment procedures. Okay, so what risk assessment procedures help in identifying and assessing the risk of material misstatement. It also helps in obtaining understanding of the entity and its environment, and including its internal control, in order to assess the risk of material misstatement and determine nature, timing and extent of further audit procedures. Okay, so this is basically what risk assessment was, right? And then we will move on to the here we skipped, I think, the audit risk. So audit risk is of two types: risk of material misstatement and detection risk. Here in risk of material misstatement there are two types. One is the inherent risk. Inherent risk means there is a risk due to the characteristic and nature of that particular financial statement item. Okay, so it is inherently risky, such as cash transactions. It is easy to steal, or it is very open to theft, right? So inherently it is risky, right? And then next is control risk. The control risk is basically the risk that the control systems of that particular entity have not worked. What is detection risk? Detection risk is the risk that even after applying the audit procedures, there is material misstatement. Okay, so that is the detection risk. Okay, next, so here auditor can only identify and assess the risk of material misstatement. Auditor cannot increase or decrease. Basically, he cannot change it. Okay, it is very simple, right? We'll just move on. We just told about all this. Yeah, so here after risk assessment procedures, he will identify and assess the risk of material misstatement, and then he will respond. How will he respond? With further audit procedures. He will either do test of control or substantive procedures. Okay, so test of control is to assure that his initial understanding of the internal control was correct. Okay, it is to ensure that the initial understanding of the internal control was correct. Okay, meaning that whether he will check whether the internal control is actually good or not. Okay, is actually good or not. Okay, he still in his basic when he was doing the risk assessment procedures, right, he would have understood the entity and its environment, including its internal control. So he has a basic understanding of the internal control, but he has not actually tested any of it yet. Okay, so here in test of control, he will test whether the company's internal control or the organization's internal control is good or not. Okay, next, he will check the design. If it is good, he will test the efficiency, whether it is whether all the control systems are working or not. Okay, if it is bad, he will not waste any more time with the control systems. He will just move on to the substantive procedure, which is this basically. Okay, so here he will do the test of details, or he will go to substantive analytical procedures. Okay, so how will he do these test of details in substantive analytical procedures? Through using these assertions. He will check the assertions. Okay, so what are assertions? Assertions are representation of management, meaning what the management has told about those particular items. Okay, so it can be account balances such as building, land, etc., right? So there can be account balances are checked through existence, rights and obligation, right, and completeness, and lastly valuation, right? Here when it comes to transaction, OC, ACC, right? For account balances it was ERCV, and for transactions it is OC, ACC. First is occurrence, next is completeness, next is accuracy, this is cutoff meaning whether it is within the period or not, like if it is relating to the correct period or not. Okay, and last C is classification, whether it is classified properly or not. Okay, so classification as in whether it is a long term, whether like you have to defer it, or whether it can be recognized right now, or whether it is an expense or an income or an asset, or whether so all that will come in this. Okay, next is the presentation and disclosure, right? Presentation and disclosure has obligation and rights. Presentation and disclosure of obligation and rights, whether it is completely presented and disclosed properly, and whether the classification is correct, and whether the values are correct in the presentation and disclosure. Okay, next. So how are these assertions checked? It is checked through AEIOU, reperform, and external confirmation. Okay, so A is through analytical procedures. Okay, what are these analytical procedures? Analytical procedures are comparing financial and non-financial information. So suppose the number of employees, suppose the amount of salaries has increased, right? So you will check whether there's an increase in the number of employees as well. Okay, so these are the basic things that you will check. And next is through inquiry. Okay, so he will inquire any person that he may deem fit. Okay, next through inspection, right? So analytical procedures through inquiry and inspection, right? Next next one is through observation. He will observe and make observation as to the internal control, or rather not internal control, with regard to how those particular transactions or event are taking place, right? And next is recalculation, right? Recalculation, just remember it like this, calculation, right? So calculation meaning he will recalculate the amounts that have been calculated by the the entity or the TCWG or the management, whoever has prepared the financial statements. He will recalculate whether those amounts are adding up, or whether the amount that they're showing is correct or not. Next is reperform. Next he will reperform the procedures that are performed by the TCWG and the management. Okay, external confirmation is asking your creditors, your creditors, or any person who is still a payable in your books of accounts, to confirm whether the amount that is being shown in our balance sheet is correct or not. Okay, so external confirmation is also possible. Okay, next. Now we will start with the new topics. Okay, so we just completed whatever we had overseen yesterday, and today we will start with this audit evidence. Okay, so what is audit evidence? Audit evidence is the information based on which the auditor reaches a conclusion, on the basis of which he makes an opinion, right? So first, the information, it is the information on which he reaches a conclusion, right? He reaches a conclusion, and on that conclusion he reaches an opinion, or he expresses an opinion, right? So the information based on which the auditor reaches a conclusion, and on the basis of which he expresses an opinion, right? Very simple, right? So it can be we can keep on writing the accounting records and other info. What does accounting records include? The journal entries, the ledgers, right? The invoices, basically multiple things. Okay, so whatever you used to do the accounting, that only is the audit evidence right here. Okay, next, this is very important, scope of audit. This is very, very important. Okay, so this is the scope of audit. So it would be better if if you focus right now. Okay, if it is somewhere else, bring it back here, right? Okay, now scope of audit, it covers all aspects. Okay, firstly, very simple, it covers all aspects. Okay, we'll just remember the keywords first, and then we'll dive into the meaning. Okay, and it increases ensure the reliability and sufficiency. Okay, so next is reliability and sufficiency. Okay, next, proper disclosure of the financial statement, and then proper disclosure. Okay, first is, it covers all aspects of the financial statement. Okay, all aspects of the financial statement should be covered in the audit. He should ensure that the reliability and sufficiency is maintained. Okay, he should ensure reliability and sufficiency. How will he do this? Through the analysis of the accounting system and the internal controls. Through what is this AIOU? These are the methods by which he will check the assertions, right? So what is A for? Analytical procedures. Next, E is for enquiry, again enquiry. I is for inspection. Next is O will be for, O is for so A is for analytical procedures, E is for enquiry, I is for inspection, O is for, damn it, I forgot. O is for observation, right? So here A is for analytical procedures, right? E is for enquiry, I is for inspection, O is for observation, and U is for recalculation, right? Recalculation, right? Next is AIOU, reperform. What reperform is? You will reperform what the management and TCWG have done, okay, to check whether he is reaching the same amounts. Okay, and then lastly, it was the external confirmation. Okay, external confirmation from outsiders, basically, right? Okay, next, so basically first is, should cover all aspects of the financial statements, right? All aspects of the financial statements, and he should ensure reliability and sufficiency through checking or analysis of the accounting system, and its internal controls. Okay, next, so this is the first point, this is the second point, and last point is proper disclosure. Okay, proper disclosure meaning should ensures proper disclosure or adequate disclosure, ensure adequate disclosure. Next, compliance with statutory requirements, accurate summary, evaluate management judgment, and lastly, you should ensure that the finance, this last point is kind of I don't know where they put it from, but out of nowhere they just explain that the financial statements are historical financial information stating the events and conditions of the entity. Okay, so basically there are only 3 points plus that 1 point talking about the financial statement. Okay, so here, so in scope of the audit is, he should cover all aspects of the all aspects of the financial statements. He should ensure reliability and sufficiency through analysis of the accounting system and the internal control. How does he do the analysis? He will do it through AEIOU, reperform external confirmation, and presentation. He should ensure that there is sufficient presentation and disclosure. Okay, meaning he should ensure that adequate disclosure is there. He should ensure compliance with statutory requirements, accurate summary of the financial information or the events and conditions of the company or the organization, and lastly, evaluate management judgment. Okay, and lastly, the financial statement is prepared as per the historical financial information of the entity, which shows the events and conditions of the entity. Right? Let's just take it out of the screen and try writing it out here. Okay, so first, in the scope of the audit, he must cover all aspects. Okay, all aspects of the financial statement. Second is that he needs to ensure reliability and sufficiency. How will he do this? Through analysis of accounting system and internal control, right? And this analysis also he will do through AEIOU, reperform external confirmation. Okay, and lastly, presentation and disclosure, right? So he should, when it comes to presentation and disclosure, he should ensure that there is adequate disclosure. He should ensure that there is compliance with the statutory requirement. He should ensure that there is accurate summary of the events of the company, and lastly, he should evaluate the management's judgment. Okay, so management judgment is actually used quite a bit, okay, in every almost every policy decision that they've made with regard to policy as in the accounting policy decision that they've made, why they've chosen that particular depreciation amount or why they've chosen that particular method of depreciation. Not only depreciation, that's just an example. So management's decision take place on multiple levels. It is within the scope of the auditor to evaluate whether the judgment that the management has taken is correct or not. Okay, so let's just revise that again for good measure. Okay, so what is scope of the audit? Scope of audit is auditor must cover all aspects. Okay, so auditor must cover all aspects of the financial statement. Next, he should ensure reliability and sufficiency, right, through analysis of financial statements, the accounting system, analysis of the accounting system and internal control, right? How will he do this? Through analytical procedures, inquiry, inspection, observation, recalculation, reperformance and external confirmation. Okay, and lastly, he should ensure that there is presentation and disclosure. When it comes to presentation and disclosure, he needs to ensure that is he should ensure that adequate disclosures are made, right? And next, he should ensure that there is compliance with the statutory requirement. Next, he should ensure that the financial statements are giving an accurate summary. And lastly, he should evaluate the management's judgment. Okay, so if you're able to remember this with me, very very well and good, or else I would recommend you to just rewind and just go through this again. Okay, because it's pretty important. Okay, next, I will recap this once more after we complete whatever is outside the scope. Okay, so what is outside the scope? If it is beyond the experience that is required, beyond the expertise that is required by the professional. Okay, so we are not experts of checking the genuineness of a particular document, whether that particular document is genuine or not, right? So that's what, or we are not experts in verifying whether that machinery, like what is the life of that machinery, or whether that has, whether it has to be repaired, or like we're not engineers, right? So it is not our expertise to make comments on that. So that is outside the scope of our audit. Okay, next is checking the genuineness of our document. Okay, checking the genuineness of documents is not up to us. Okay, so it is, we are not experts of checking genuinity. Okay, so that is a part where there is a part of the audit risk actually, because we won't be able to we are not able to check the genuineness of documents. So like if so there is a question actually where the management of the TCWG had given a statement, or a false document basically, and based on this the auditor concluded that there was no misstatement, okay, which is basically wrong. So here is the auditor liable. Here the auditor is not liable, because checking the genuineness of the document is outside the scope of the audit. So auditor will not be liable. Okay, so we need to remember that. And next, audit is not an inquiry into misconduct. Okay, so we don't know whether there is a misconduct or not. We are just there to check whether the financial statements are prepared in all material respect free from material the financial statements in all material respect is free from material misstatement or not. Okay, we are just there to check that. So we don't come in to particularly inquire about a misconduct, so that would become an investigation, right? So here investigation is not in the scope of our audit. Okay, so it is outside the scope. It is, we come with a positive outlook. We just come to check whether everything is correct or not. Okay, in an investigation they particularly come to check whether, or if there whether who committed that crime, or who committed that particular fraud or something, that we are not interested in. We are interested in whether the financial statements are prepared in all material respect free from material misstatement or not, like, or all the financial statement are free from material misstatement or not. Okay, basically that is our objective. So checking or an inquiry into the misconduct is not in the scope of an audit. Okay, and next is audit is not an investigation. Okay, see, investigation is a detailed examination. Audit is a broad examination, right? Or rather, it's only detail into financial statements. Okay, so we do not touch any other topic. Okay, only the financial statements accuracy we check. Okay, next, there's a specific purpose. For example, here there was a misconduct, and looking into that misconduct, the investigation will be taking place. So that is, we do not come with a specific purpose, but however our only overall objective is to find out whether the financial statements are prepared in all material respect free from material misstatement or not. Okay, next is, in an investigation the focus is, it's very focused and narrow. However, here it is broad, right? In audit it is broad, it is not focused, or it is not narrow. It is broad, and we cover quite a lot of aspects as to the financial statements. Okay, so here auditors do not have the authority to conduct searches, or we cannot take any sworn statements. Okay, so we cannot take any affidavits, or sworn statements by the people. We have a right to ask. We have a right to ask, but we cannot demand it. Okay, we have a right, but we cannot demand that particular information be given to us. All we can do is report. In our audit report we can disclose that particular problem. Okay, so let's just recap from the top. Okay, again. So what is in the scope of audit, right? One second. Yeah, scope of audit. So basically let me just scroll it down with more area, right? So what is in the scope of audit? First, it is to, what is the first thing? Try telling it, before I tell it, First is to cover all aspects. Okay, all aspects of the financial statements of all aspects of the financial statements. Okay. Secondly, it is to correct. Okay. So which is reliability and sufficiency. Okay. To ensure reliability and sufficiency. Okay. How do you do this? Through analysis of accounting system and internal control. And how do you do this analysis? Through AEIOU, reperform external confirmations. Okay. And lastly, presentation and disclosure. So what does the auditor need to do? What is the scope of audit when it comes to presentation and disclosure? It is to ensure adequate disclosures, ensure compliance with statutory requirements. Next is ensure that the financial statement provide an accurate summary, right? Provide an accurate summary. And lastly, it is to evaluate management's judgment, right? And there's one more point that they had put in the suggested answer and the ICI book, so we will just write it as is because that's what gets us the marks, right? So financial statements are nothing but the historical financial information and which shows the events and conditions of the entity. So this is the scope of audit. Okay. So if this is the scope of audit, what is outside the scope of audit? Firstly, it is if such a matter is beyond the expertise. Okay. Secondly, checking genuineness of documents, right? Right? Third, we need to remember that audit is not an inquiry into a misconduct. Okay, audit is not an inquiry into misconduct. And fourth, audit is not an investigation. Okay, so how is it different from an investigation? Investigation is with a specific purpose, right? It has a specific purpose. It is focused and narrow, right? Lastly, what is there outside the scope of audit? What is the last thing outside the scope of audit? It is that we cannot conduct any searches, right? We cannot conduct any search, and we cannot take any sworn statements from any person. What else do you have to remember? That we have the right to ask. See, we have the right to ask, but we cannot demand that information, or we cannot demand that statement from them. Okay. Next, when it comes to audit risk, we had already covered this up there. I'll just so audit risk is ROMM, right? ROMM is the risk of material misstatement. This is the management's risk. Okay, auditor can only identify and assess it. He cannot change the ROMM. So only management can change. How can they change it? Through design, implementation, and management of internal control. Okay, only through DIMIC they can reduce it. Okay. Now detection risk is the auditor's risk. Okay, what is the detection risk? Detection risk is the auditor's risk. Now auditor's risk is the risk that, let me just scroll over, right? So the detection risk is the risk that the auditor will express an inappropriate opinion when the financial statements are materially misstated. However, the opposite of this is not true. Okay, so basically it's common sense. Okay, so I'll tell you why the opposite of it cannot be true. Okay, so if it is not materially misstated, so we'll just discuss what it's saying here. Okay, so it is saying here that there is material misstatement. So here, what kind of an audit report would you give? If it was pervasive, you would give an adverse opinion. If it is not pervasive, then you would give a qualified opinion. Okay, but in this case, in inappropriate opinion means here here, either this can be appropriate or this can be appropriate. What is not appropriate here? What is not appropriate is giving a unqualified opinion, right? Or an unmodified or unqualified opinion. Meaning, what does these two mean? They mean that there is no misstatement, or the auditor is reasonably sure that there is no misstatement. There is no material misstatement. Okay, so that is obviously wrong, right? So here there is material misstatement, and he is giving an inappropriate opinion, meaning he is giving a unmodified or unqualified. Now the opposite of this is not true, because if there is no material misstatement, right, there's no material misstatement. When the auditor tells that he's going to give an adverse opinion or he's going to qualify the opinion, the management and those charged with governance will come and ask, what is the basis? What is the basis for your opinion? Right. So then the auditor should be able to give a reasonable explanation as to why he's giving this adverse opinion or qualified opinion. Right. So you cannot just hand out these adverse opinion and qualified opinion as per his whims and wishes. Right. So in this case, obviously those charged with governance and the management will ask the basis for that qualified or adverse opinion, right? So that's why the opposite of this is not true. Okay, so it is already even asked in exam also. So it is important to remember that detection risk is the risk that the auditor will express an inappropriate opinion when the financial statements are materially misstated. So meaning, in other words, there is material misstatement and the auditor has given a unmodified or an unqualified report or an unqualified opinion. Okay, right. Now here next is, it is the auditor's risk. Okay, the auditor can increase or decrease. How can he increase or decrease? Through further audit procedures, either through increasing his test of detail. Test of detail is another very formal word. I mean, it's kind of wrong for me to explain it like this, but just for a basic understanding, test of detail is like vouching, right? So it is like vouching. And next, or he can use substantial analytical procedures, right? How does he do these two? He'll do it through checking the assertions, right? Assertions. So this is simple, right? Next, however, detection risk can never be zero. Why it can't be zero? Because of there are some things that are inherently risky, right? There are some things that are inherently risky, or because some things might be beyond our expertise. We are not experts of checking genuineness of documents. Okay? So these are the reasons why detection risk cannot be reduced to zero. Okay. Now, further these. So if in this case, if you can see that even this risk of material misstatement cannot be zero, detection risk also cannot be reduced to zero. So can audit risk as a whole be reduced to zero? Can it be reduced to zero? No, it can't be. It can't be reduced to zero. Okay. So audit risk cannot be reduced to zero. That's why an auditor gives only a reasonable assurance, right? Auditor gives only a reasonable assurance and not an absolute assurance. Reasonable assurance is correct. Absolute assurance is not correct. Okay. Next, moving on to inherent limitations of audit. Okay, what is the inherent limitations of audit? Inherent limitations of audit is that, I mean, this is the base that you have to start with before writing your answers of the actual inherent limitations. So basically, there are 5 inherent limitations. So before writing those 5 inherent limitations, you will have to give this as a base. Okay, meaning this is how you will start with your answer before writing the actual 5 inherent limitations. Okay. Firstly, you will have to explain that the audit risk cannot be reduced to zero. Okay, so audit risk can never be reduced to zero. So that's why audit cannot provide an absolute assurance. Okay, audit evidence is only persuasive. Okay, here don't confuse yourself with the pervasive that we learned. That is pervasive. This is persuasive. Persuasive means influencing or persuading, right? So don't confuse it with pervasive. Pervasive is different. Persuasive is different. Okay, so here audit evidence is only persuasive and it is not conclusive. Okay, meaning it only indicates that it is, but it is not like it is 100% sure. Okay. Next, inherent limitations of audit cannot be overcome irrespective of nature, extent, and timing of audit procedures. Okay, so irrespective of how many audit procedures you like how much our audit procedures you do, it still cannot be overcome. Okay, so we'll just revise these four, and then we'll go into the inherent limitations, and then we'll revise all together. Okay, so we'll revise those four plus the five. Okay, so firstly we'll just go through it again over here. So audit risk cannot be reduced to zero. Audit cannot give absolute assurance. Audit evidence is only persuasive, not conclusive, and inherent limitations of an audit cannot be overcome irrespective of the NET of audit procedures. Okay, we'll just go off the screen and we will try to write it over here. Okay, firstly, what do we have to write? Audit risk cannot be zero, right? It cannot be reduced to zero, right? And audit can give only reasonable assurance. It cannot give absolute assurance. Okay, it can give reasonable assurance, it cannot give absolute assurance. Third one, it is audit evidence is only, be careful about what you write here, persuasive. Okay, it's persuasive, not conclusive. Okay, and last point is that inherent limitations of an audit cannot be overcome irrespective of nature, extent, and timing of audit procedures. Okay, so these are the four things that we'll have to write before starting this inherent limitations of audit. Okay, so what are the inherent limitations? Firstly, it is nature of financial reporting. Okay, so PPFS, preparation and presentation of financial statements, involves judgment by management. Okay, and this judgment is very subjective in nature, right? So it depends on each and every management. So a different management can come to a different conclusion or different judgment, right? So PPFS is involves judgment by the management, which is subjective. Okay, and the management is responsible for internal control. So obviously there can be a bit of there is a bit of control risk that is involved. There is a bit of inherent risk that is involved, right? So internal control also gives only a reasonable assurance. Okay, so what comes first is the nature of financial reporting. FR stands for financial, R stands for reporting. It is in the nature of financial reporting. Okay, because in financial reporting we rely on or the financial statements are prepared as per judgment of the management. So when it comes to many accounting policies, the management of judgment is involved. Okay, so that is why it is this is one of the inherent limitations of an audit. Okay, next, nature of audit procedures. See, as soon as you say nature of audit procedures, these two words should immediately click. Okay, so practical and legal. So as soon as you say nature of audit procedures, you should tell it is neither practical or legal. Neither practical or legal. Neither practical or legal. Right? Management may see this is very simple, right? So it is neither practical nor legal. Why? How is it not practical? It is not practical to check all the documents, right? And there are certain legal limitations, such as we don't have the power to search, we don't have the power to take sworn statements from the management, right? So those are the legal limitations. Okay, so management may not provide proper info, they might fabricate info, or management has transactions with related party in a written format that we might not be aware of, right? They might not disclose this fact that they are related party, or they might have any they might have kind of hidden the fact that that person is a related party, right? So these are the, because of the nature of audit procedures, it is neither practical or legal. There are practical and legal limitations, right? What is practical? We cannot check all the transactions due to the size and the nature, right? And there are certain legal limitations because as we cannot conduct searches, we do not have the power to take sworn statements, right? And lastly, the last 3 points are related to the management. So the management is not giving information, giving fake information or fabricated information, right? And lastly, they have related party transactions that are very well hidden. Okay, so they have related party transactions that are hidden, right? And third inherent limitation is the audit is not in the nature of investigation, right? It is not in the nature of investigation, meaning it is a one second, yeah. See, investigation is a detailed examination. It is conducted with a specific purpose in mind. It is very focused and narrow, right? It is focused and narrow. We are not conducting an investigation, right? Next, timeliness of financial reporting and decrease in relevance of information. See, as time goes by, the relevance of information drops down. Okay, so as time goes ahead, the information value will keep on reducing. So it will, at this point, it will basically have no value. Whether you disclose it or not, it won't have any value, right? So if there is any you know what do you say, so if there is any disclosure that is to be made here, right, and the year ended out here, but you're making your report at the end of almost September or October, and that time you're giving the audit report in the general meeting. So about what happened here, it would have lost its relevance, right? When it comes to certain parties, or when it comes to certain information, it might have lost its relevance, right? So as time increases, as time passes, there is a decrease in relevance of the information, right? And there should be a balance between the reliability of information and its cost. Okay, so you can achieve a high reliability, by taking like a massive audit team with you, right? But taking such a massive audit team with you is going to cost you. What if there reaches a time when the cost of conducting the audit has surpassed the amount of fees that you've charged? Like suppose the cost of the audit is, let's say, 8 lakhs, right? The cost of the audit is 10 lakhs, but your audit fees is only 8 lakhs, right? So here the cost of the audit and the fees that is charged there's no balance between the reliability info and the cost, right, that has to be paid for it, right? So we'll have to keep that also in mind, because that is also an inherent limitation of audit. Okay, and future events. So here, auditor is not guaranteeing. We cannot guarantee any future event, whether the company is going to be successful, or whether the company is going to keep on succeeding, like whether it's going to continue or not. So we cannot enter into any we cannot comment on any future events, right? With this remember the names and the topics, the headings, and then we will go to the study material, or the material over here. Okay. Okay, so when it comes to inherent limitations of an audit, what will we write? We will write firstly that audit risk cannot be reduced to zero, right? Cannot be reduced to zero. Secondly, audit provides only a reasonable assurance, right? Reasonable assurance. Next, audit evidence is persuasive, not pervasive, persuasive in nature. Okay, it is persuasive, not conclusive. Okay, and the last point is that inherent limitations of an audit can't be overcome by increasing the nature, timing, and extent of further audit procedures, or of audit procedures. Okay, so now what are the inherent limitations There are 5, right? 1, 2, 3, 4, and 5. Okay, we'll try to make space. Okay, first is nature of financial reporting. Nature of financial reporting. Here, what and all can you remember? Firstly, that it relied on, financial statements are prepared, or PPFS involves management judgment, right? It involves management judgment. It involves internal control that is designed by the management, right? So it can never, and internal controls only give a reasonable assurance. This internal control gives only a reasonable assurance. So that there's nature of financial reporting, that is also the first inherent limitation of auditing. Okay, next is nature of audit procedures. As soon as I say nature of audit procedures, what are the two words that are supposed to come? It is not practical. There are practical and legal limitations, right? And then the management is not giving proper info, or the management is giving fabricated info, or the management has entered into related party transactions, right? Next, third one was that audit is not an investigation, right? Audit is not an investigation, right? It is not an investigation, meaning it is not a detailed examination. There is no specific, rather, investigation is a detailed examination. There is a specific purpose, and the objective is very narrow, focused and narrow, right? And the fourth inherent limitation is that timeliness and relevance of information, right? What are I think there are only two main things over here, that as time passes, the relevance of the information decreases, and there has to be a balance between the cost and the reliability of the information, right? Timeliness and relevance of the information, there are only two major points over here, that as time passes, the relevance of the information reduces, and there must be a balance between the cost and the reliability of the information that is obtained. Okay, and lastly, future events, right? Future events, we are not expected to take any future events into consideration, because we are giving an opinion on the historical financial information, right, and not on the prospective financial information, right? We'll just go back to the material here, and this will just come from the top. Okay, I think we had to start from audit evidence, right? Yeah. So here, information used by the auditor in arriving at the conclusions on which the auditor's opinion is based. So information on which the auditor will arrive at the conclusion. He'll arrive at the conclusion, and on the basis of this conclusion, he will express an opinion, or he will base his opinion on this conclusion, right? So based on this, he will express the opinion, right? Next, the audit evidence includes both both information contained in the electronic accounting records underlying the financial statements, and any other information. Okay, next, now, as I told you, the information that accounting records can be whatever, like the invoices, contracts, ledger, journal entry, like whatever is required to make the accounts, or whatever is necessary for the process of accounting. Okay, next, any other information includes minutes of the meetings, confirmations from the trade receivables, and the manuals containing details of internal control. Okay, next, audit risk. What is audit risk? This audit risk was actually the detection risk, right? What was the detection risk? Detection risk is the risk of the auditor. It is the risk of the auditor's risk. Now, just to check the concept, what is management's risk? Management's risk is what? ROMM. ROMM includes two what? Inherent risk and the controlled risk. Okay, fine. Let's just get back here. Right? The risk that the auditor expresses an inappropriate opinion when the financial statements are materially misstated. Right? Let me just go back to what the problem was, right? Can the opposite of this be true, where there is no material misstatement? When there is no material misstatement, but auditor gives, in this case, can there be an inappropriate opinion? Would this also fall under audit risk? The answer is no, it does not fall under audit risk. Okay, only if there is an inappropriate opinion when the financial statements are materially misstated. So meaning, if there is no material misstatement and there is an inappropriate opinion, it doesn't fall under audit risk. Okay, so only when there is material misstatement and there is an inappropriate opinion. Okay, moving on. Next, what is not included in audit risk? That's what you are saying. The auditor might express an opinion on the financial statements are materially misstated when they are not. Okay, so this is not an audit risk. Okay, audit risk is a technical term related to the process of auditing. It does not refer to the auditor's business risks, okay, such as loss from litigation or adverse publicity or other events arising in connection with the audit of financial statements. Next, these inherent limitations are as per SA 200 itself. Okay, what is SA 200? You have to keep telling the entire name of the essay if you're telling SA 200, right? SA 200 is overall objectives of the independent auditor and conduct of an audit as per standards on auditing. Right? So this is your Uyakasa, right? That's how I was been taught by Edu 91. Okay, so I remember he like Neeraj Arora sir keeps saying, that there are people who keep teaching but without giving him credit. I didn't want to be that, so with due credit over here, right? Next, so what did we learn over here? Firstly, we had to write those three or four points, right? First is that the audit risk can never be zero, right? So audit risk cannot be reduced to zero, and then we cannot obtain absolute assurance. We can obtain only reasonable assurance, right? And the next point is this is because inherent limitations of an audit which results from audit evidence, right? The audit evidence is persuasive, right? It is persuasive rather than conclusive. Okay. Next is the process of auditing is it suffers from certain limitations, and these limitations cannot be overcome irrespective of the nature, extent, and timing of the audit procedures. Okay, so these are the 4 points that you have to write in the beginning before coming to the actual inherent limitations. First is the nature of financial reporting. Okay, so preparation of financial statements involve making many judgments. These judgments are actually it's written right here. Okay, these judgments are subjective decisions, right? Or there is a degree of uncertainty, right? So therefore the auditor may not be able to obtain absolute assurance that the financial statements are free from material misstatements, right? So next, one of the premises for conducting an audit is that the management acknowledges its responsibility for the preparation of financial statements, right? And it is responsible for devising its own internal controls. And what we know, internal controls give, again, reasonable assurance, not absolute assurance. So therefore the nature of financial reporting is also an inherent limitation of auditing. Okay, next is the nature of audit procedures. As soon as I say nature of audit procedures, what are the two things? Practical and legal should come into mind. Okay, it is neither practical or legal, as there are practical and legal limitations. What are the practical limitations? You cannot apply audit procedures to 100% of the transactions, or all the transactions cannot be checked, right? What are the legal limitations? We cannot conduct searches. We cannot take sworn statements, right? We cannot take sworn statements. So these are the and we'll just go through all of this also. So here, auditor does not test all the transactions, right? He does not test all the transactions in all the balances. He forms his opinion by testing only samples. What is this also called? Test checking, right? This is also called test checking. Application of audit procedures to less than 100% of the transactions is called test checking. Okay. Here, management may not provide complete information. Like what did I say? Those three management problems is that they are not giving information, no info, or they're giving fabricated info, right? And lastly, that they have entered into related party transactions and they've not disclosed it, right? We'll just go through it. Management may consist of dishonest and unscrupulous people. Unscrupulous means basically untrustworthy people, and by itself, they themselves might be involved in that fraud. So they may be engaged in concealing the fraud by designing sophisticated and carefully organized schemes, which may be very hard to detect by the auditor. So we can write this point also, that they are in charge of, they might have created very sophisticated, carefully organized schemes, which maybe which make detection very hard for the auditor. Okay. Next, auditor is not an expert in authentication of documents. As we learn, we are not an expert in checking the genuineness of the documents. This is also then outside the scope of auditing. Okay, it's outside the scope of audit. Okay, it's quite possible that the entity may have entered into transactions with the related party. Such transactions may be only on paper transactions, but may not have actually occurred, right? So the auditor may not be aware of such related party transactions, or audit procedures may not be able to detect probable wrongdoings. Okay, you can pause, and if you want to go through it on your own, you can do that now. Okay, next. It is not in the nature of investigation. Audit is not an investigation, right? It is not an investigation. Hence, the auditor cannot obtain absolute assurance that financial statements are free from material misstatement. Okay, next. What is timeliness? Again, we know the relevance of the information decreases over time, and the auditor cannot verify each and every matter. Okay, so therefore there has to be a balance between reliability of information and cost. Okay, so these are the 2 points over here. And lastly, the future events. Here, future events may affect an entity very adversely. Okay, adverse events may seriously affect the entity's ability to continue, meaning it can affect the going concern of the entity, right? Next, the business may cease to exist in future or due to change in market conditions, emergence of new business models, right? Because of these limitations of an audit, there is an unavoidable risk that some material misstatements may not be detected, even though audit is properly planned and performed in accordance to the standards of auditing. Okay, so they can put this line maybe and say, there is an unavoidable risk, blah 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 blah, and then they can just put full stop and then just put comment on this. So when they put this, you have to understand that they're asking for the inherent limitations of an audit. Like, you have to detailedly explain all of this depending on the amount of marks that they're giving, right? So you have to explain all this. That's it. Okay, we'll move on to the next point. Okay, firstly, who appoints the auditor? Auditor is appointed by the entity's owners or members. Okay, in case of governments, it is appointed by the controller and auditor general. Okay, they keep saying the word COMPTROLLER is pronounced as controller. Okay, it's pronounced controller. Okay, don't say comptroller. Okay, I don't know why it kind of gets on my nerves, but it's actually called Controller and Auditor General of India. He appoints the auditors for government companies. Okay, for government companies. Next, in case of firms, the partners will appoint the auditor. Okay, sometimes it may be appointed by the government authorities under specific laws or regulations such as tax laws. Okay, next, to whom is the report submitted? Obviously to the person who appointed us. Okay, so whoever appointed us submitted to the appointing party. So whoever appointed the auditor, suppose A appointed it and B is the auditor, B will give the report to A. Very simple, right? Next, the different types of assurance engagements, right? Here, audit gives you a reasonable assurance, review gives a moderate assurance. Moderate assurance is lower than reasonable assurance. It is not high, right? Reasonable assurance is reasonable assurance. How do you define it? It is high level of assurance, but not absolute, right? Here, review gives you a moderate level of assurance, right? Next, However, the key things that you have to remember in audit and review is these two talk only about historical financial information. Okay. However, other assurance engagements can relate to prospective financial information, meaning these projections, forecasts, right? Projections and forecasts. Okay. Right. Now, here, a review engagement is an example of a limited assurance. Right? It gives a limited assurance engagement. Okay. Entities not legally bound may opt for financial reviews rather than the audit. Okay. Review provide assurance, cost less and cause less disruption. Okay. So the amount of data, the amount of access that we'll have to give to the auditor, the amount of checking that has to be done by the auditor is far lesser. Okay. So that's why it gives a lesser level of assurance than compared to an audit. Okay. So if an entity is not legally bound to get itself audited, it will move towards financial review. Okay. Because it will provide a very moderate level of assurance, right? And it will cost less, right? And there is less disruption. Okay. Next, both audit and review are related to financial statements prepared on historical financial information. As I was telling you, audit and review, right? Audit and review are based on historical financial information, whereas other assurance engagement can be related to prospective financial information also. Okay. Next, let's move to this, the difference between reasonable assurance and limited assurance. Okay. Here thorough procedures are used. Here less detailed procedures, right? Here we do the test of controls, we do the substantive procedure, we award a substantive procedure into the test of detail, right? And then substantive analytical procedures, right? More procedures are involved. Okay. Thorough procedures. Here less detailed procedure, just inquiry, analytical procedure, right? What would we talking about, that AEIOU, right? So those are the things that he will just provide. Okay. So here thorough procedure, less detailed procedure, high level of assurance, moderate or lower assurance. Okay. Here subject matters confirm with the suitable criteria in all material respect, meaning reasonable conclusions are okay. Here subject matter is plausible in the circumstance, meaning here only they've given a example, right? But here it is plausible, meaning it is there is a moderate level of assurance that is being given here, right? Nothing has come to our attention that causes us to believe that financial statements are not prepared in all material respect, as compared as to this audit report, like the opinion that is given in case of an audit, right? In our opinion, financial statement give a true and fair view of the financial information and the financial position uh, in accordance with the applicable financial reporting framework. Here it says nothing has come to our attention that it is materially misstated. Here we are saying that it is true and fair. It is giving a true and fair view. Here we are saying nothing is, we didn't find anything that showed that it is not true and fair. Here we are saying that it is true and fair. Here we are saying it is true and fair. Here we are saying we didn't find anything that would show us that it is not true and fair. So did you understand the difference, right? So in lower level of assurance, we give a negatively worded opinion, right? We give a negatively worded opinion. Here we give a positively worded opinion. Okay. So when it comes to an audit, there are more regulation and more standards that has to be followed. Here there is less regulation, less standards to be followed. Okay. Next we'll move on. Okay. So here, as I told you, other assurance engagements can also be related to matters other than historical financial information. Meaning what? Prospective financial information. Meaning it could be financial information or any other, such as giving assurance on internal control, right? So it is not only financial information, and when it comes to financial information, it is not only HFI, it's not only historical financial information, it is also PFI, prospective financial information, right? And it is also giving assurance as to internal controls and such other assurance engagements. Okay. Next, assurance as to prospective. Okay, we'll just come back to my handwritten notes for a second, right? We'll just see. Okay, So all these come later. Right. Okay. Now, what is a prospective? What is prospective financial information over here? Prospective financial information is the assumption or events that may occur in the future or possible action by the entity. Okay. So, what assumption or an event that may occur in the future or a possible action? So, it is either an assumption or an event that may occur in the future, may occur, or it is possible action by the entity. Right, possible action by the entity, or it includes a forecast or a projection or a combination of forecast and projection. Okay, so what is these assurance engagements use, or what is this prospective financial information governed by? It is governed by the standards of assurance engagement. Okay, it's not SAAE, it's actually SAE. Okay, so standards on assurance engagement. Okay, so the practitioner must ensure that assumptions are not unreasonable. Okay, and the prospective financial information is properly prepared as per these assumptions itself. Okay, so here it's not like you have made certain assumptions but you have not used those assumptions at all. So firstly, your assumptions must not be unreasonable, and secondly, though the PFI should be prepared as per those assumptions itself. Okay, and the presentation must be proper and material assumptions are properly disclosed. Okay, let me just. Okay, so what does the SAE tell when it comes to prospective financial information? It tells that the assumption should not be unreasonable. So assumption should not be unreasonable. PFI should be properly prepared as per the assumptions. Presentation should be proper, and material assumptions should be properly disclosed. Okay. Next, here practitioner gives only a moderate assurance. Moderate assurance or a lower assurance, or what else do we call it? A limited assurance. Okay, limited assurance. Okay, it gives a negatively worded opinion. Again, it says nothing in these in this prospective financial information. Nothing was found in these prospective financial information that led us to believe that the assumptions or the fact that this is unreasonable or unattainable, something like that, they will be. Okay. Next, practitioners should not vouch for accuracy of the forecast. Okay. So this is basically regarding a prospective financial information. Okay, we just read it from here actually once. Okay, so here prospective financial information is the financial information based on the assumptions about events that may occur in the future and possible actions by the entity. Okay, so it is assumptions about events in the future or and possible action by an entity, right? Next, or it can be in the form of a forecast or a projection or a combination of both. Okay. Next, in assurance reports involving prospective financial information, practitioner obtains sufficient and appropriate to the effect that the management assumptions are not unreasonable. Okay, they are not unreasonable, and the prospective information is properly prepared on the basis of these assumptions, and it is properly presented, and all material assumptions are adequately disclosed. Okay, very simple, right? When it comes to prospective financial information, it is the financial information that is based on the events that may occur in the future or reasonable actions by an entity. It can be in the form of a forecast or projection or a combination of both, right? In an assurance engagement or in an assurance report involving prospective financial information, the practitioner obtains sufficient and appropriate evidence to the effect that the assumptions that are taken by the management are not unreasonable, and the prospective financial information or the financial statements are prepared properly as per the assumptions that are reasonable. And next, it should be properly presented, and all material assumptions that have been taken are properly disclosed. Okay. Next, here. The auditor is not in a position to express an opinion as to whether they will be achieved or not. Okay, he will not show, that's what he will not vouch for the accuracy. Okay, he will not vouch for the accuracy of the data, or he will not vouch for the accuracy of the presumptions that have been made. Okay, next. Hence, the type of assurance engagement provides only a moderate level of assurance. Okay, next we'll move on to the next part. Is there anything else that we might have missed? Okay, we just have to cover these short notes, right? Short notes on SQC, right? Short notes on SQC, essays, SAE, SRE, and SRS. Okay, so after this we just have to finish the qualities of an auditor, qualities, and then lastly I think that's pretty much it, right? After the qualities of, and then benefits of audit, I think. Yeah, here qualities of an auditor is there, and then I think benefits should be somewhere here itself. Yeah, benefits of an audit. Okay, so let's just do it from here, and then we'll jump into those short notes. Okay, and maybe in the next video I'll start with the question bank, so that we can go with the question bank, or if people who are already quite comfortable with the content of whatever there is in chapter 1, they can just jump into the question bank part, right? So here, what are the benefits of an audit? Benefits of audit is, firstly, it gives a high quality information, right? Okay, so how I was taught this is basically, this is very important, right? This is only the headings, right? So that you can remember the headings first, and then for the subject matter we'll dive into the material. Okay, yeah. So here, how I was made to remember all these were connecting it to the kind of upbringing our parents, or how the relation with our parents are, right? How the relation with our parents is, right? So it's like our parents give us high quality information, right? And they safeguard our interest. So our parents safeguard our interest, they keep a moral check on us, right? And then they save us from any liabilities and lenders, right? They save us from any liability and lender. But what do? We commit fraud and error, right? And they will put appropriate review controls on us, right? So we'll just go off the screen and we'll try to memorize that, right? So first, our parents will give us high quality information, right? And they will high quality information. Next is, they will safeguard our interest, right? They will safeguard our interests. Next, they will protect us from liabilities. Liability, what kind of liability is this? This is the government tax liabilities, right? Government tax liabilities, they will help us from lenders, right? But we will commit fraud, like we will try to cheat them, or we'll try to we'll try to go over their heads, right? So we'll commit fraud or error, right? And also they will keep a moral check on us, right? Or we can just put that out here, they'll keep a moral check on us because we commit the fraud and errors. And they will also take take proper control reviews, right? They will take proper control reviews. So these are the benefits of audit. Okay, so these are the benefits of audit. So firstly, they will give us, our parents will give us high quality information. They will safeguard our interests. They will save us from all liabilities and lenders, but we will commit fraud and error against them. But they will keep a moral check on us, and they will ensure proper control reviews are taken against us, right? Just jump into this. Right here, audit of accounts provides us with high quality information. It gives confidence to the users that the information on which they are relying is qualitative and the outcome of the exercise carried out is recognized globally. Okay. Next, in case of company, shareholders may or may not be involved in the day-to-day affairs. So therefore, it kind of safeguards the interest of the investors, or safeguards the interest of the shareholders. Okay. Next, it keeps a moral check on the employees from committing fraud or for the fear of being discovered by the audit. Okay. Next, this is helpful for government authorities for determining tax liabilities, right? Audited financial statements can be relied upon by the lenders before making any credit decisions, right? And then it is also used for detecting fraud or error or both, right? An audit reviews the existence and operations of various control operating in any entity. So it is useful to point out any deficiencies in the control systems. Okay. Next, so here this is an overview of the kinds of engagements that are there in audit ethics, like the kinds of auditing that can be done or the kinds of engagements that can be entered into. Okay, so firstly there is assurance engagement. Okay, so the assurance engagement relating to historical financial information. So when it comes to historical financial information, if you're giving a reasonable assurance, meaning if you're giving a high level of assurance, then it is called an audit. If you're giving a moderate or lower level of assurance, it is called a review. Okay, what governs audits? Audits are governed by standards on auditing. What covers reviews? Reviews are governed by standards on review engagement. Okay. Next, when it comes to other than HFI, other than historical financial information, that can either be for example, prospective financial information, or it could be assurance engagement as to the internal controls, right, or any other item, etc. Right. So these other assurance engagements are governed by standards on assurance engagements. Okay, and other related services. What does related services mean? Here it could be making reconciliations, right? So making reco or any other agreed to services, right? Agreed to services. So these come under other related services, right? Next, those are governed by SR, not SREs, it's actually SRS. Let me just change that over here also. SRS. Oops. Okay, so standards on related services. Okay, so it is governed by standards on related services. Okay, moving on. Next, as per quality control, this SQC-1, the SQC-1 which is there, there's only one standards on quality control, which is SQC-1. Okay, SQC-1 is applicable on all engagements, whether it is audit or is it review or any other engagement, or it could be related services. It is applicable to all. So basically what it is telling is it is requiring firms to maintain quality controls with regard to audit, review, other engagements or related services. So basically all engagements, right? So it is asking the firm to keep quality control and work as per I think statutory and regulations and law, as per the law. Okay, and make sure that the report that is given is appropriate in the circumstance. Okay, it is appropriate in the circumstance. Right. Next. So these short notes I will do it from the material right now, and after discussing the qualities of an auditor. Okay. So basically, this is the base. This is the base that has to be put. Right. So this is the base that is required to be written before writing these. Right. Let's just go over that. Here, what are the qualities that an auditor must have? The auditor must have all the qualities required for a good business. Okay, so he must be independent. When it comes to what does independent mean again, when we discussed in the previous video and as well as while I was revising yesterday's topics, what does independence mean? It means that the judgment of the auditor is not what is the keyword, is not subordinate to the judgment of any other person. Okay, not subordinate to the judgment of any other person. Okay, cool. Next, holds position of trust, which is in basic human qualities, right? Must have knowledge of an expert. Okay, he must have knowledge of that of an expert. Okay, what knowledge an expert must have, he must also have the same amount of knowledge. Okay, or rather knowledge as required by an expert. Knowledge as required by an expert. So that makes more sense, I feel, right? Next, he must have exhaustive knowledge of accounting. Obviously, I must have an expertise in accounting. Sine qua non. Okay, sine qua non is second to none. Okay, like it should be like nothing should be. This is like a must. Okay, exhaustive knowledge of accounting is a must. Okay, so what are the things that he must have? He must have all the qualities required for a good business. He must be independent. He must hold a position of trust, right? He must have knowledge as required by an expert and exhaustive knowledge of accounting. Okay, next, when it comes to the actual qualities, this is where the actual answer starts. So he must be tact, he must be cautious, he must have a good temper, there must be firmness, he should have integrity, and his judgment as in he should be able to make judgment, right? And he must have patience and clear-headedness. Okay, so basically when you're accounting, you should be tact, right? You should be tact and cautious. You should have a good temper, firmness, integrity, judgment, patience, and clear-headedness. Okay, so let's just try to memorize it. So you should be tact, you should be cautious, right? You should be cautious. You should have a good temper, right? Good temper. What else? Good temper, and maybe judgment, clear-headedness, patience. I'm pretty sure I'm missing something. Okay, so here, tact, cautious, good temper, firmness, integrity, judgment, patience, and clear-headedness, right? So there are how many? 1, 2, 3, 4, 5, 6, 7, 8. Okay, so you must be tact, cautious, good temper, firmness. Tact, cautious, good temper, firmness. Tact, cautious, good temper, firmness. Okay, tact, cautious, good temper, firmness. Integrity, judgment, patience, and clear-headedness. Integrity, judgment, patience, and clear-headedness. So tact, cautious, good temper, firmness. Tact, cautious, good temper, and firmness. Integrity, judgment, patience, and clear-headedness. Okay, that's kind of like a tune, right? Tact, cautious, good temper, firmness. Tact, cautious, good temper, and firmness. Integrity, judgment, patience, and clear-headedness. Okay, so here, right? Tact, cautious, good temper. Tact, cautious, good temper, and firmness. Good temper and firmness. Integrity, judgment, patience, and clear-headedness. Okay, Tact, cautious, good temper and firmness, integrity, judgment, patience and clear-headedness. Tact, cautious, good temper and firmness, integrity, judgment, patience and clear-headedness. Tact, cautious, good temper, firmness. Tact, cautious, good temper, firmness, integrity, judgment, patience and clear-headedness. Tact, cautious, good temper, firmness. Tact, cautious, good temper, firmness, integrity, judgment, patience and clear-headedness. Okay. Tact, cautious, good temper and firmness, integrity, judgment, patience and clear-headedness. Okay, next. I think we can move on to the short notes. Okay. Right. Here. Okay. Starting with the SQC. Okay. So as I discussed earlier, SQC has been issued to establish standards and provide guidance regarding a firm's responsibility. So it is the firm's responsibility to maintain a system of quality control for the conduct of audit and review of historical financial information. Right. So here, basically, what is SQC1? What is the name of SQC1? It is quality control for firms that perform audit and review of historical financial information and other assurance and related services, basically of everything, right? So whatever the engagements that we had discussed, it is all covered here, right? So quality control for firms, right? For firms that perform audit, review of historical financial information and other audit engagements or other audit assurance or other assurance and related services engagements. Okay, so quality control for firms that perform audit, review of historical financial information and assurance engagements and related service engagements. Okay, so this is SQC1, right? This is the name for SQC1. Let's tell it again, right? Quality control for firms that perform audit, review of historical financial information and assurance engagements and related service engagements. Okay, next. SQC1 has been issued in this regard. It requires auditors and practitioners to establish a system of quality control so that the firm and its personnel comply with the professional standards, regulatory and legal requirements, and reports issued are appropriate in the circumstance. Okay, next. Right, I think this is covered in that chart that I made. I'll just remake that right here. Okay, so engagements based on assurance, right? Based on assurance, here again split into two parts: historical financial information and others. Right, again assurance and others. Right, here HFI can be either an audit or a review. Right, here it can be any other assurance engagement. Here it can be related services. Okay, here for audit, what is covered here? SAs are covered. Here for reviews, it is SRE, standard on review engagement. For assurance, other assurance engagement is SAE, standards on assurance engagement. And lastly, for related services, it is standards on related services. Okay, next. Next, standards on auditing are SAs. Okay? Standards on auditing apply in audit of historical financial information or historical information. They can also be termed as performance benchmarks. Okay, so standards on auditing apply in audit of information. They are also termed as performance benchmarks. Okay, so they bring uniformity. Okay, so first is that they are audit of historical information. They're also called as performance benchmarks. Okay, next is that it brings uniformity, right? It brings uniformity and it covers a broad range of topics, right? It covers a broad range. Okay, includes, what does it include? Basically everything, like relating to engagement, relates to planning, materiality, documentation, so quite a lot of things. Okay, next. So this is only based on the standards on auditing. Okay, short notes on standards on auditing. Next we'll come to standards on review engagements. Okay, so standards on review engagement apply for apply the context of review of financial statements and review engagements, right? It gives a limited assurance. Reviews a limited assurance engagement. It provides assurance that is lower than what is provided by the audit. Okay, so review also provides assurance to the users obtaining sufficient and appropriate evidence. Okay, so here also you have to get appropriate and sufficient evidence. Okay, next, standards on auditing and standards on review engagement apply to historical financial information that we have already discussed, right? So what are the key things over here? First is SREs apply on the review of financial statements or review engagements relating to the financial statements, right? It is a limited assurance, right? It gives limited assurance, meaning it is lower than the assurance that is given by the in that of an audit. Okay, here also you have to obtain sufficient and appropriate audit evidence or assurance evidence, right? And lastly, SREs and essays and SREs are in relation to historical financial information only. Okay, next, standards on assurance engagement. Firstly, it applies to non-historical financial information and includes various assurance service beyond audits and review of historical data, meaning prospective financial information or aspects like internal control. Okay, so these are assurance engagement. And lastly, the SRS. Okay, in SRS, engagements for agreed upon procedures, whatever is agreed on the financial information, or compilation engagements where no assurance is provided. Okay, basically there's no assurance that is provided, just an agreed upon procedure is given. Okay, so what does related service mean? It can either mean agreed upon procedures on the financial information or compilation procedures or compilation engagements where no assurance is given. Right? No assurance is given here. Right? Next, they outline the practitioner's duty, such as which can include specific financial data checks or assisting in preparation of financial statement without expressing an opinion. Okay, so if he is preparing any financial, if he is assisting in preparation of financial statements, he cannot express an opinion. Okay, next, an engagement in which a practitioner may be called upon to assist the management with PPFS. Okay, with PVFS without obtaining assurance. Basically the same thing again they've just put here. Okay, next. Okay, duties and quality control standards. Okay, now are essays completely mandatory to be put? Yes, I mean, like, you have to follow the essays, but in certain cases where the essays would be ineffective, or if you have a better way of better standard or procedure on which you can perform the audit, you can deviate from the standards of auditing. Okay, but however, you have to document how these alternative procedures how these alternative procedures are performed to achieve the purpose, and you have to record the reason for the departure from that particular standard, right? And his report should also draw attention to these departures. So firstly, he should document what alternative procedure. So he should document the alternative procedures. He should also record the reason for such departure, right? Why the reason for the departure. And lastly, he should bring attention in his report. He should bring attention to these departures, right? Okay, first, what are the alternative procedures that he has put in place that has helped achieve the objective of the procedure, and in his he should also give reason as to why he departed from the procedures. Okay, and lastly, in his report he should bring attention to these departures. Okay, next. Now, however, if you just in your report say that disclosure stating that you have not complied with the relevant standards does not exempt you from following them. Okay, so disclosure in a report does not exempt accountants from complying with relevant standards. Okay, basically that's what it is. Okay, simple. Next, I think this is the scope of audit. We've already covered this, right? Benefits of audit also we've covered. Yeah. Okay, here audit is conditionally mandatory. Okay, it is may not be legally mandatory for all entities. However, companies, certain non-corporate entities are required by law to undergo. Okay, so turnover exceeds thresholds. Basically, this is conditionally mandatory. If they satisfy that condition, then it will become mandatory. Okay, entities like school may need not to qualify for government grants. Audit isn't necessarily always compulsory. Many organizations opt for voluntary audits due to the benefits of audit. Okay, next, we've covered this also. We'll just read through here. Okay, so tact, caution, firmness, good temper. Tact, caution, firmness, good temper. Integrity, judgment, patience, and clear-headedness. Okay, next, and you must have integrity, trust. Auditor who holds a position of trust must have basic human qualities apart from technical requirement, and he must have knowledge of an expert. When he is called upon to critically review the financial statement, it is obviously useless for him to attempt the task unless his own knowledge is that of an expert. Okay, and he must have exhaustive knowledge of accounting. Okay, so it is sine qua non of the practice of auditing. Okay, next. Okay, how is how do you ensure the financial statement would not mislead anybody? It's very simple, right? So let me just right. So here the accounts have to be prepared in reference to the entries, and the entries should be supported with evidence. No entry should be omitted, and information conveyed is clear and unambiguous, and the amounts are classified, described, and disclosed properly as per the accounting standards, and it gives a true and fair view. So how many are there? 1, 2, 3, 4, 5, and 6 points are there. Okay, so first it is saying that the account should be drawn up as per the entries, and the entries should be supported by sufficient evidence, and no entry should have been omitted, and information is clear and unambiguous, and the amounts are properly classified, described, and disclosed. And lastly, the statements of accounts provide a true and fair picture of assurance to the users. Okay, or true and fair picture of the operation of the entity. Okay, let's just go off the screen, right, and then we will try. So how does he ensure? He ensures that it is not misleading anyone through by checking these things. Okay, what are the things? Firstly, he should ensure that the accounting entries, right, or the accounting entries, or rather the accounts are drawn as per the relevant entries, right, relevant entries. And next, entries have sufficient and appropriate evidence right. No entry has been omitted. No entry is omitted. No entries are omitted. Next, the financial statements, or rather the amounts, are properly disclosed or properly classified, disclosed as per whatever financial reporting framework is being used, and the financial statements give a true and fair view of the entities operations. I think one is missing over here. Let me see what that is. What did we miss? Yeah, we missed that the information conveyed by the statement should be clear and unambiguous. Okay, so it should be clear and unambiguous. Okay, next, that's it. Okay, cool. So here, relationship of audit with other subjects. Okay, we'll just dive into these detailed one right here. Okay, so here, when it comes to auditing and accounting, auditing reviews the financial statements, which are nothing but a result of overall accounting process. Okay, so this is how auditing and accounting are related. Auditing and law is related, as the auditor should have good knowledge of business law affecting the entities. Auditing and economics. Auditor is expected to be familiar with overall economic environment of the client. Auditing and behavioral sciences. Knowledge of human behavior is essential for an auditor to effectively discharge his duties. Auditor is also expected to have knowledge of statistical sampling for meaningful conclusions and mathematics for verification of inventories. So basically arithmetical accuracy, and here it is statistical accuracy. Okay, next, auditing and data processing, EDP. EDP auditing is in itself a discipline in itself, right? And auditor is expected to have knowledge of financial techniques such as working capital management, fund flow ratio analysis, and capital budgeting. Basically, everything that is there in costing, right? And or costing and FM, right? Basically, not costing, sorry, FM. Everything that there is in FM. Auditing and production. Good auditor is one who understands the client and his business functions as a production and cost system. Okay, next. The word audit comes from the Latin word audier, which means to hear. The Industrial Revolution of Europe increased the demand of audit. In India, Auditor General was appointed in 1860 and Institute of Chartered Accountancy was established in 1949. Okay, so that's pretty much it. And there is one more role here. I think the question bank that we will go through tomorrow, maybe. I think there's about 26 questions, and the ICI material also, we just go through it tomorrow. Okay, cool. Thank you. Bye bye.